Hey, everybody. Welcome to week 188, the first one of 2024. How about that? Yes, and there are all kinds of new surprises, in 2024. Thank you, government, with the Corporate Transparency Act, and we're going to go deep and long on that. And the one thing, if you hear nothing else from this entire presentation today in this dialogue, do not call your CPA for this. Call Jack. So, anyway, we're going to go deep into a very convoluted structure, and Jack will have some examples of how convoluted it is. so, um, and before we dive into it, Adam, anything like we haven't heard from you for it's been 3 weeks now. So, so we took 2 weeks off for Christmas vacation and all that. Any rants you want to go on before we dive into it?
No, not a rant. An unintended positive benefit of inflation is that the tax rates adjusted up, meaning the brackets raised. Percentages are still the same. It's just the income threshold that you hit to get into those brackets went up a little bit. So, you know, if you didn't if you didn't get a raise due to it, then guess what? You just got a tax cut. That's that's really it, Gary.
What what
Other than that,
what,
other than
what
that,
did it go from?
I'm trying to tune in and hear what Jack has to say because we're getting blown up on this topic.
All right, cool. Well, we'll dive into it then, Jack, and then once we exhaust that, we've got other things that we can go into. But um, you know, well, first of all, welcome everybody. We've already got 40 people on here, so that's about, a third more than what we normally do. So the topic is hot and the threats are real. So let's go into this, Jack.
Good morning. Happy New Year to everyone. Um, I have a little side note that has been on my mind that I wanted to share, and it is my daughter's going to kill me for saying this, but um, I witnessed a significant performer, athlete, businesswoman, and wasn't expecting that. And so over the holiday, and I'm not a Swiftie, but I'm pretty close to it in watching this woman perform. Now,
Oh, she's amazing.
my daughter and my wife went to Denver to go to the live show, and I saw the expense of doing that, and I was like, okay. But how brilliant is it to re-release all of your songs under your production company, and those are the ones that are playing on XM and Sirius Radio and otherwise, to then publish a movie of the concert that people can go see in the theaters and then publish it in streaming media, which is where I saw it. And then watching this performance where there's no drum solos, there's no guitar solos. It is her and her dancers and her singers going on and on and on. And then the mad magician in her and others with the outfit changes and
Oh
everything.
yeah.
And she never stops. And then it occurred to me midway through that she's wearing heels, not stilettos, but heels the entire time and running around. I mean, so and packing. It was at SoFi. So I mean it was packed. And I guess she did 2 or 3 shows. So anyway, just was thoroughly impressed
Yeah.
by that. And if that business model, being able to recycle stuff over and over again, and then they're going to something on Friday night for I think it's maybe the orchestra that is playing or somebody's playing her music and paying more money to go see that the same stuff. So um, I want to look more into that business model and see how that is done because that it's absolutely brilliant. And
Yeah.
she hustled for it. She did a lot of work. If you see the documentary that she did a lot of work during COVID and put together a bunch of songs and stuff like that.
Yeah.
So
Did you see?
So Jack,
Did you
on that
see what?
note, Gary will respect this. If you Google like what was her training regime, she said that she ran on a treadmill for 3 hours a day while singing the entire set list over and over. And I think about that, I'm like, that is a whole nother level of dedication that does not exist in me. that is unbelievable.
Yes. And Matthew Hart chimed in on the chat for everybody to see the same exactly what you said. It's unbelievable. So, hey, she set the bar pretty high for 2024. What do you say?
She did. Let's all be like Taylor Swift as far as business owners, right? Okay. All
Right.
right. So let's talk about the CTA. And I would say that generally speaking, it's not that it came up from behind and surprised us. We knew it was coming. I think that there was maybe not full attention to it until later in the year. Had people here at Shoemaker that were saying, okay, it's coming, we got to be ready, we got to be ready. And I would say that, fortunately, when we put together a task force across our offices in the US and came up with, and I'm going to share some of this stuff and I'm going to anticipate the question, which is, hey, can you send us a copy of this stuff? Um, the answer is a polite no. And the reason being is there are a lot of hours, non-billable hours that went into producing this stuff so that we would have internal guides for us, because the reality is that the lawyer, as Adam said, he's getting and Gary getting blown up, but ultimately it's, hey, your lawyers need to be doing this stuff. And so we obviously took it very seriously, and it can be complex. At its core, what it is that if you are a beneficial owner of a company in the US or a foreign company doing business in the US that's registered in the US, you have to submit certain information into this federal database that has been created. It's not the Secretary of State's website. It's not the IRS website. It is a separate federal entity that is geared toward law enforcement. And so, and I'll share with you who can get access to all these records. And so I'm gonna, I could spend hours doing, explaining all this, and there's going to be exceptions. So keep in mind what we talk about is not the rule; it is the mainstream of the rule, and there's going to be exceptions and exceptions to the exceptions and those kind of things that go through. But ultimately, what you'll see is the purpose of it is to catch bad actors. And unfortunately, in order to catch the bad actors, you have to sweep everyone into this regime and say, all right, everybody has to report, because you can't tell who the bad actors are just by, looking at them and everything else. You have to have this detailed information and have the capability to analyze this information. So as I have been saying for years, I don't think we're at the point of Terminator where the machines are going to, blow us all up yet. But technology is progressing to a point where government agencies and others can use this technology to do things better, like law enforcement, like put pieces together as to, why is this person, this person owns this business and they are involved in illegal activity, so they're beneficial owners in this other business, which may be a front for illegal activity. So that's really what's going on behind the scenes. So a lot of academic material, and as you guys know, I don't like reading. I like having more of a discussion, but today warrants a little more of a lecture. Certainly ask questions as they come up, but I want to make sure I get it right. So I'm going to go through, and I want to make sure that I do it in a timely basis, so to keep on track of things. So starting at the beginning, and the Corporate Transparency Act was enacted by Congress in January of 21 as part of the William M. Mac Thornberry National Defense Authorization Act for fiscal year 2021. The purpose of the CTA is to protect national security and protect against illegal activity by detecting and deterring money laundering, tax evasion, and other bad actors by requiring entities created or doing business in the U.S. to disclose their beneficial owners and other identifying information. So there you have it. They're looking for bad guys, but they got to look at all of us in order to find the bad guys. And so what type of entities are impacted? So it is existing and newly created entities. There was a misconception earlier on that this is only for new entities. It is for every entity, whether it was formed 10 years ago, 5 years ago, 5 minutes ago. There's different rules. There is a line as of January 1st of 24, which we'll talk about, but then at 25, it's 30 days for everybody. So entities created, organized, incorporated in any state, meaning any state in the United States, as well as foreign companies with U.S. operations. The governing agency, which is called FinCEN, it's an acronym, expects up to 32.6 million entities to be reporting companies under the rules. There are a number of exclusions for public companies and wholly owned controlled portfolio companies. We'll discuss that a little bit as well. Initial compliance deadlines. So there was a push that if you knew you were going to form an entity in 2024, to form it in 2023, because for two reasons. One is, well, it's the same reason, but two sub reasons. One is that you don't have to report any of this until January of 2025. Moving forward. And secondly, you have potentially a change in the White House, which means a change in governing regulatory agencies and those kind of things. And so this could all be repealed potentially or modified. And so basically kicking the can down the road. I don't think it's going to completely disappear, even if there is a change in the White House. But I think that it may be, depending on which way it goes, maybe a softening. And so, or maybe even punting it out to even later than 2025. So people are saying, well, let me go ahead and do that so that way I don't have to worry about it for another 12 months or so. So any entity that was formed after January 1st of this year has 90 days to report this information. And as I said, those already in existence have until January 2025. Talked about foreign entities are also included. Reporting companies created or registered after January 2025 have 30 days to report. Entities that, I'm sorry, let me take that back. Entities that were created in January 1, 2025 have 30 days to report the information. So, I've thrown out several definitions that I haven't really defined, or defined terms that I haven't really defined. So there's no limit on beneficial owners that need to be reported. And what do they do with the information that is provided? So you have the ability for FinCEN to share with a number of other governmental institutions, agencies, and regulators. Those include national security agencies, federal law enforcement, foreign law enforcement, state and other local law enforcement agencies with a court order. So you can't have Charlotte-Mecklenburg police just go and start. They don't have immediate access to this database, essentially. There has to be a process for doing that on a local level. It is a federal database, so they don't want to give everyone access to this information immediately. There has to be a proper purpose stated and essentially adjudicated via court order for local penalties for noncompliance. So if you're in the 90-day period of filing, you have that 90 days to file the correction. Otherwise, it's 30 days to file a correction. And what are the penalties? They are both civil and criminal. It could be a $10,000 fine and 2 years in prison if there is a willful withholding of information. Okay. And then the story doesn't end there. If there is a change to the beneficial owner roster, then you have 30 days from the point of change to make that change officially into their system. So it's a consistent, constant so you're going through a transaction, whether it could be a stock sale, it could be just a change in ownership, it could be part of your succession plan, it could be that an owner passes away and then the ownership interest transfers to someone who is not currently a beneficial owner as listed with the database. So I want to show you, and not to scare you, but for you to understand that this is complex, the decision tree. So what we've done here at Shoemaker is we've put together the internal memo as to, okay, how we're going to handle this, who's going to handle it. We have people that are designated. We have questionnaires that will go out with the entity formation questionnaire. So we send out questionnaires when we're asked to form new entities, and is who are the members, who are the managers, who are the shareholders, who are the directors, who's the registered agent, all these things. Now you're going to have to provide additional information and copies of things like passports, driver's licenses, etc. We'll also talk about who are the filing individuals or who are treated as filing individuals. If you file, you are a filing individual. If you have an assistant or a colleague file the document, they could be deemed a filing individual. For me, it may be that my paralegal files that or my assistant files that, so they become the filing agent or the filing individual. We are basically putting that responsibility onto a paralegal. But if I'm involved, then I am also need to be listed as a filing individual. So we'll talk about those things in a moment, but I'm going to see if I can share my screen to show
While
you.
you're doing that, we had somebody raise their hand, and if you guys have questions, hit us in the Q&A. That way, I'll monitor it and I'll interject when needed. But somebody had raised their hand. Is there a question before we go in? If you do, just let me know. Hit me in the Q&A.
All
All
right.
right.
So this is page 1 of 11-page slide deck internally to us to make sure we're making the right decisions and filing the right information. So, and I'll talk about this as we go through this, but so you start out with, okay, is the filer an entity? Very simple question, but then it leads to all of these questions. And then you have a large operating company exemption, which we'll also talk about. Other exemptions, which we will talk about. So you see things like banks, credit union, governmental agencies, nonprofits, and those kind of things. So, what needs to be provided? So we have all that guidance there for us, for our paralegals to be putting in. So we'll talk about beneficial owners. There is either determined by ownership percentage, but also by control. You may not be an owner of record, but you may have sufficient control to be deemed a beneficial owner of the entity, which we will also talk about. So again, here's the Cliff Notes version of what we need to do to think about as we're going through this process to get to a point where, yes, this person needs to be reported into this database. Who is the company applicant? That's what I was talking about, whether it's me, my paralegal, you, your assistant, your colleague, whoever it may be. And then we have examples of those that were put together. So for various professionals in our offices so that we can get it right. So I will continue onward outside of those examples. Okay. So we've talked about the definitions of what is an entity. So it's LLCs, it's limited partnerships, it's corporations, trusts. Certain trusts are also reporting agencies, limited liability partnerships, general partnerships, which we don't see a whole lot of, except maybe in some real estate investments where you have a general partner and limited partners for certain reasons. Large operating company exemption. So the entity must employ more than 20 full-time employees, have an operating presence in the United States, and have filed federal income tax or information return last year demonstrating at least 5 million in gross receipts or sales, net of returns or allowances from sources within the US. So a couple key provisions. It's not just 5 million. It is $5 million sourced in the US. Because then you have affiliation rules within the tax code. And now I'm really stepping out of my lane as to, is income from in a foreign country, potentially by an affiliate or whatever, is that counted as income for US tax reporting purposes and things like that. So I'm sure Adam can spend more than a day on talking about that kind of stuff. So, okay. We talked about a little bit about, or you saw on the chart, types of exempt entities. Those would include things like governmental authorities. Now, I know you can't see this in front of you, but it's things like if the entity qualifies for exemption if both of the following apply. So you have certain, even though it's an exemption, there are certain rules within each exemption or qualifications within each exemption. So it's not that you can say all nonprofits, because this was a question that was brought maybe a couple of weeks ago when I teased everybody with a little snippet of what was to come, meaning today, that not all nonprofits or not-for-profits or charities are automatically qualified. I would say that most of them, C3s, the charity organizations, are likely going to be. But then you have, for those of you who are familiar with or involved with charities, you can have an income producing business within a charity that has separate reporting and tax payments and those kind of things. That is, I think is it unqualified business income or something along those lines. But it's a fancy way of saying that income generated by that subsidiary or that other business unit within the nonprofit is going to get taxed a certain amount. So financial institutions like banks and credit unions, money transmitter business, so the Western unions of the country, again, it says if A and B, then yes, you can exercise the exemption. Securities exchange, so brokers, investment companies, investment advisors, so those that are licensed appropriately to basically deal with your money. Venture capital funds, insurance companies, state licensed insurance producer. Here's an interesting one, a public accounting firm. An entity qualifies for exemption if entity is a public accounting firm registered in accordance with Section 102 of the Sarbanes-Oxley Act of 2002. So there you go.
Whoa.
All right.
Hey, we
yes.
did get a question in here from Douglas, and he said, "Can you say again the significance of the 5 million?"
Absolutely. So there is a large operating company exemption. I don't know the reasoning behind that, except that I think that when you have a large company, it's harder to hide bad stuff. Now, that is totally a Jack theory or a dad theory, as my kids would say. But it's similar to, like, in the franchise world, if you have a high enough revenue, you don't have to register with the 14 registration states to be able to sell franchises in that state: California, New York, Illinois, Maryland, Virginia, and others. And so the large operating company exemption has 3 prongs to it, and you need to meet all of them. So employ more than 20 full-time employees, have an operating presence in the US. Either you do or you don't, and you either have 20 employees or you don't, which is not true necessarily, because if you're counting part-time employees, then there is a calculation to deal with, do you really have 20 employees? Similar to how things were with the PPP, how many employees do you have? Do you have full-time equivalents and all those kind of things? But what you're asking about is the third prong, which is having filed a federal income tax or informational return last year demonstrating at least $5 million in gross receipts or sales, net of returns or allowances, but it has to be from sources within the US. So the revenue has to be generated within the US for 2 reasons. One is obviously there would be issues of jurisdiction if they were to lump everything in, but I also think that there are issues with bringing income that is generated outside of the US into this regime that would potentially qualify people into the exemption where they shouldn't be, because their income is even greater. Their foreign income may be greater than their US income. So that is going to keep less people into this exemption, essentially. All right. And then there are other exemptions. We talked about tax exempt entities, so the 501(c)s. And then there's entities assisting tax exempt entities. So if you are assisting a 501(c), you potentially might qualify. Inactive entities, and I don't know how to make that happen necessarily with the IRS. I know that Adam and Gary do, but just assume that is the case. Then you get into rules when you have a more sophisticated organizational chart, an entity chart. So you start talking about subsidiaries of exempt entities. And there are rules that, and it says in the materials, one of the most utilized exemptions will be the subsidiary exemption. This applies to any entity whose ownership interests are controlled or wholly owned directly or indirectly by an exempt entity. And then there's some exceptions. A qualifying direct or indirect subsidiary would be exempt from the CTA as a result of the parent company's exemption. So you have a waterfall effect that if the parent company is exempt, then likely the subsidiary will be exempt as well. But again, there's exceptions and exceptions to the exceptions that have to be navigated through for that. Um, so, and then there's obviously definitions of what control and controlled means. Um, Interestingly, there's not definitions within the CTA itself, so you have to look at other federal regulations. I think eventually they're going to have to define what that means. And they're going to have to say, when we say control or controlled by, controlled or controlled by, this is what it means for purposes of CTA. And they may say, go see the regulations on, in the tax code or treasury regulations for that and adopt those. But, and then a big note, direct or indirect parent company or other affiliate is not automatically exempt under the subsidiary exemption unless they qualified for the exemption. So it doesn't go upward. It flows down, but doesn't necessarily flow up just because your subsidiaries are exempt. It may be that your parent is not exempt either, or is not exempt regardless. Brought up the concept of beneficial owners. So what we have is, again, definition, beneficial ownership is determined by determining each owner's direct and indirect ownership percentage and which individuals fall within the broad definition of substantial control. The same individual can qualify through both ownership and control. Likewise, an individual can be an owner but not exercise what the CTA defines as substantial control. And you must have at least one beneficial owner reported for each reporting company, which makes sense. Okay, reporting requirements. And there are several of them, but the core is date of birth, residential address, and unique identification number, and a picture of the validly governmental issued identification, passport, driver's license, state of local ID, foreign passport if no other options are available. So, have those identification items ready because your attorneys will be asking for copies of them. And, I would say many times when people send me stuff, they take a picture of it. That's not going to be sufficient. We're going to need something that is not, crooked, that may have a missing number or something on it. Now, I have an app on my phone that will turn a picture into a PDF, and so it's called Genius Scan. I don't make any money from selling that. In fact, we were told that we could use that during COVID, but to use it sparingly. And I have continued to use it a lot and haven't gotten in trouble yet. Well, I should say I haven't gotten caught yet. So until someone tells me differently, that's what I use. And so we will need something that is readily available and demonstrates and has the information that is needed and is not, blocked or smudged or whatever it may be. There are excluded categories for beneficial owners. You don't have to pony up your kids' information. So minors, minor children, as long as a parent or legal guardian of the minor provides the required information. So, if you are, technically minors cannot own stuff. They can't sign contracts and those kind of things. So, the way to get ownership of a business into a minor's hands essentially through trusts. And so it would be the trustee that would be reporting information and potentially the beneficial owners if they're not minors. And so there's again whole regime surrounding trusts and irrevocable trusts, all those things. A nominee, intermediary, custodian, or agent acting on behalf of another individual. So it may be that you have someone that is doing your stuff for you, or maybe individually, that person would not be reporting. They would be reporting your information. They don't have to report their personal information. An employee of a reporting company acting solely as an employee, and not as a senior officer. We're going to talk about officers and control and stuff like that. So right now we're talking about ownership.
So, hey, Jack, let me
Yes.
interject one just to go back, make sure that everybody got this. The stuff that they've got to have: date of birth, current address, current driver's license or passport. Anything else? Do they need birth certificates or anything like that?
I mean, it would be so full legal name. I don't know if I said that. So, not many people know this, but Jack is not my real name. Not on my birth certificate. It is an inherited nickname. It's actually Jackie. Jackie is the inherited nickname. And then I think at some point in my teens, people started dropping the IE and started calling me Jack. So all good.
Ah,
Yes. So yeah, that covers everything. Now, information about the reporting company itself would be full name of the reporting company, any trade name or DBA, complete current address for U.S. companies, the principal place of business. So your principal, if you have multiple addresses, it's your principal place of business. The state or tribal jurisdiction of formation or registration, IRS tax ID number and employer identification number, if or a tax ID number issued by a foreign jurisdiction and the name of the issuing jurisdiction. So those are the requirements for the company and for the individuals. All right, let's see. Okay. Excluded categories. So a few more. Individuals whose interest in a reporting company is a future interest through a right of inheritance. So just because you have a contingent interest in potentially in the future as a beneficiary that other than maybe a trust, but just through inheritance, that in the will you're going to get something, then that right of inheritance is not a reporting requirement. And then a lender or other creditor of a reporting company would qualify as a beneficial owner solely through the rights or interest in the company for the payment of a debt and other obligation due. That is a fancy way of saying a security interest that a bank has. They are not deemed a beneficial owner of the company, even if they have rights to grab that ownership interest as collateral for the loan proceeds that they have given to you potentially. There is some discussion about reporting companies owned by exempt entities. And so again, that just becomes part of the decision tree on yes, no, is it a reporting company or not? Determining, well, ownership percent, there's a process for determining ownership percentage that is in more details. I do want to point out that it does include direct and indirect owners. And what do I mean by that? Direct ownership or control is when an individual directly owns an interest or controls the entity based on his or her direct interaction with the entity. An indirect ownership typically occurs when an individual or entity has an ownership interest in an entity and that entity owns another entity. Okay, so the stacking of the corporate organizational chart. Then you have to look into types of ownership interests. And the definition in the CTA is pretty broad. So it includes equity, stock, or similar instrument. Kind of, Captain Obvious there, right? Any capital interest or profit interest, including all types of membership interest in the LLC in an equity, in an entity. So that includes profit interest, economic interest. So formalized non-management type interest in an LLC. What it doesn't include, I don't believe, is when you say, okay, well, it's a profit interest, but it really isn't. It's a bonus. It is something that the amount is calculated based on the performance of the entity. It is calculated as if you were a 10% owner. It is paid to you and it represents 10% of the net profit of the company, but you're not an owner. So it's not a distribution to you. It is income, ordinary income, and you pay ordinary income tax. Now, hopefully, I've not misstated any of that, Adam, because you're not like, your hair's not on fire. But so I will assume that that is accurate. So it doesn't include that. It does include the equity, the profits interest.
So Randall hits a good question. As we expect from Randall, how would warrants be treated?
Um, because it doesn't have that in here, but it talks about um voting trust, certificate of deposit, business trusts, anything that is transferable, classified as a stock or anything similar or confers voting power or voting rights. Um, which depending on the type of warrant, does it come with voting rights? But I don't know in this moment if a warrant is covered under this. I can look and find out and ask my colleagues who are knee deep into this, but that's a great question because you have other forms of ownership interests that are springing potentially. You have maybe even non-certificated rights that are pursuant to an employment agreement or to a shareholders agreement or something along those lines. So I am not sure about that, but that's an excellent question. I will find the answer to it.
All right.
Because things like puts, calls, straddles, or other options are included, but it doesn't say warrants in here. So I'm thinking it likely yes, but because it is not a necessarily a warrant typically you can't take away. I mean, there are forfeiture rights potentially under them. So that's why I just don't know because it really depends on the nature of the warrant and the rights under that warrant. Um, it talks about trusts and as ownership interest and who needs to be the reporting and a trust as an owner in an entity. And if the trust is determined to hold control directly or indirectly and at least 25% of the ownership interest or have a substantial control, the trust and the trustee could be deemed the beneficial owner, despite the fact that a trust obviously has beneficiaries. And then, so it says the trustee could, the beneficiary potentially could, depending on whether the beneficiary has control over the trust. And a grantor on a revocable trust or has the ability to otherwise withdraw the assets or any part of the assets, meaning income potentially, is also included. So again, a lot of moving parts in the decision tree process, and I'm really teasing you with this stuff, but just to give you general knowledge that this isn't just a matter of okay, have a 25% owner, but it's in a trust or I'm a beneficiary of a trust that owns 25%. I mean, it's pretty expansive. Um, all right, we've talked about beneficial ownership through true ownership. There is this whole other side called substantial control. The first category, well, let me share the definition. An individual can be deemed a beneficial owner if such person directly or indirectly exercises substantial control over the reporting company. This can be the same individual as like the 25% owner that we talked about, so that you qualify as a beneficial owner under the actual percentage ownership, or you don't, but you're also deemed that. Okay. Senior officers is the first category. So it says that examples of a senior officer are not provided in the CTA, but there are some examples that would likely apply, which would make sense, which is a CEO, president, CFO, COO, vice president, treasurer, manager, capital M. So a director of an LLC, a manager, a managing member, or a general partner. So all those potentially could be deemed senior officers and therefore deemed a beneficial owner through substantial control. Interestingly, appointment authority is also included, which means the authority to appoint or remove a senior officer or authority to appoint or remove a majority of the board or similar governing body. So if you delegate the power to manage, and that includes potentially the ability to do these things, that person or people who have that power could potentially be deemed a beneficial owner through substantial control. Okay. Influence over business decisions. There are some examples that are included in that, which is determining the nature, scope, and attributes of the business, including the sale, lease, mortgage, or other transfer of any principal assets. And before I continue on the list, again, not trying to be Captain Obvious, but I mean, some of these things, it's like, oh yeah, of course, you are going to have control. Some of these other things, it's like, okay, wouldn't have thought that maybe necessarily. So again, these are just examples. This isn't a catch-all or be-all list, but so we talked about transfer of assets, reorganizing, dissolving, or merging the company, determining major expenditures or investments, determining issuance of equity, incurrence of debt, or approval of the operating budget, determining business lines or ventures or geographic focus, determining senior officers' compensation, bonuses, and incentive programs, entering into, terminating, or fulfilling or not fulfilling significant contracts, or
Hey,
amending.
Jack,
Yes.
let me interject a couple questions that
Yeah,
have come from
absolutely.
all of this. So one is Randall says, what if you have a non-operating LLC and it doesn't conduct business or hasn't been properly or legally closed?
So, I mean, technically it's an issue, but I mean, it's, I would imagine, again, Jack theory, because I'm not the one that's going to be knocking down your door or saying, pay us $10,000. I mean, the reality of it is that I think that they're looking for the bad actors. And if you show them that, okay, inactive entity, no tax returns, it's just a technicality that it was in your system or somehow you found out about it. But I mean, the best thing to do is to formally terminate that entity, which is an interesting thing because I know clients that have multiple entities that have a habit of letting the company die on the vine. Um, I would suggest that maybe you not do that anymore moving forward, that you want to have some finality to it. It's not terribly difficult. It's not terribly expensive to do that from the legal side of things. Filing a final tax return, I would imagine is not terribly difficult because you have to file it. You just have to make it your final. Um, so I would say don't do that anymore. But I don't think that you are, if you do have one of those or decide to continue to have one of those, are you really going to be on the hit list for penalties? Probably not.
All right, and here's another one that came in from Matt or Matthew. He said, in a transition, if two owners have more than 25% and the transition stock does not fall below 25% for either, are there any changes to be reported? For instance, this isn't an exercise of reporting ownership stock, just the people. If in the same transition, if one of the owners falls below 25% as the other owner increases, is there a process for removing that beneficial owner? A lot to that one.
Yeah, there is. What is still to be determined is the guidance for those kind of situations, which is where you have somebody either, well, obviously, if someone is going into the reporting requirement, then there's a reporting requirement. But what if someone is removed from that reporting requirement? And so it basically is, I think, and I have to go back and see what the see if I can answer that on the spot. Let me that I'm not sure about. I don't want to give misinformation as to the ins and outs being right on the line of 25%. My understanding is that, if there is a change in beneficial owners and it create either someone gets into the box, or if somebody comes out of the box, then that needs to be reported. But don't hold me to that. I will find out for 100%. Okay. Back to, okay, substantial control. Okay, we talked about compensation, dealing with significant contracts. amending the governance documents, including articles of incorporation, organization, bylaws, operating agreement, shareholders agreement, and significant policies or procedures. They threw that one in there. I mean, you would think, again, obvious governance documents, operating agreement, bylaws, shareholders agreement, but now you start talking about significant policies or procedures. Okay, you have an HR
Define
person.
it.
Exactly. It's undefined. It's
Define
in
it.
lowercase. And so, is that your HR person who is an employee and has just been tasked with developing significant policies or procedures because that's what's needed and they have the qualifications for doing that. So, there's a lot of loosey-goosey stuff in here that is going to have to be further developed. Hopefully not in the chaotic way that the SBA did with PPP on every 2 hours coming out with a change to a frequently asked question response. Okay. Other methods of substantial control. Dominant board member, owning or controlling a majority of the voting power, having rights associated with any financing arrangement. Okay, what does that mean? Does that mean that an owner who is the bank essentially for the company by lending, so owner financing its operations? I think that's what that means, but I don't know. It doesn't say. Financial business or other arrangements with other individuals acting as nominees. So having maybe not written arrangements, but the ability to influence the business and its major decisions. And then any other written or oral contract arrangement, understanding, relationship, or otherwise might rise to the level and get you into the definition of substantial control. So you can see as the list progressed to get into more of the gooey, undefined stuff. But again, keeping in mind what is the purpose of this, and also keeping in mind the practicality of enforcement on this. They only have, the government only has the resources to go after people. Now, is this going to be weaponized by a disgruntled employee or disgruntled owner? And so that's to be seen. And I would imagine, and again, I probably shouldn't have said that because maybe now I've just encouraged people to do that. But I mean, the reality is that you're supposed to be doing something, you're not doing something. You're supposed to be doing something as mandated by the federal or state government. You're not doing it, and you threaten, okay, well, I'm going to go report you. And so the government's just going to have to deal with that influx of people just wanting to use it as leverage. And then I think kind of lastly, I know we're kind of running out of time a little bit, but determining the company applicant. So who needs to be reported as the applicant for the beneficial ownership reporting to the federal government. Obviously, the individual who filled out the document for forming the entity or registers a foreign entity in the U.S., or the person who directs or controls the filing of the formation or registration documents. And they give some examples of a paralegal or assistant making the filing would be the company applicant. If an attorney, officer, or owner directed such person to create the entity, they would also be a company applicant. So, if you're the person who said, go form this new entity, then you are deemed a company applicant, even though you're not the one who actually put the information into the database. So I think that is everything that I wanted to cover. So I'm going to stop there because that was a lot.
This is taking me back to PPP, man. I'm having flashbacks. And that's why we had 55 or 50. Yeah, we had 55 people on here. So for anybody that's new to this, or if you need a reminder, we will put this thing up on the BGW CPA YouTube channel. And I think Shoemaker has a similar channel too.
We do.
So we'll put that up later on this afternoon so you can go back and review because there's a lot of stuff here. But if you were going to say, hey, what are the big takeaways from this thing? Like, I got to do this. What would that be, Jack?
I would say either become very familiar with these reporting requirements if you're going to form an entity or have any movement in the ownership of your company. Or, and again, this is not a solicitation, it's just the reality is that you need to find a professional to help you through it.
Yeah.
And I think you guys have been at BGW been very clear that you guys are not going to touch this because why should you? I mean, the attorneys should have the information that is needed when they're building this relationship with the client. But I mean, it may be that there is a participation, like if you guys have information, it may be a client that says, okay, send them the tax returns from last year because the ownership is the same. They can pull the information from there. They can pull addresses from K1s. They can do all these things. And so, that's to facilitate that. But I think that, having the discipline to do one or the other is going to be very important for moving forward. It is going to be chaotic. And so, the chances of getting caught, again, Jack theory, don't hold me to this. This is not legal advice to not follow the new law. But the reality is that, okay, how are you going to get in trouble if you mess it up? I would say don't ignore it, but if you mess it up, all is not lost. But we have put together the vehicle to help clients get through this. Other law firms surely I know have done this as well. There are organizations out there that have been formed. So you remember the people that were going to help you with your PPP applications and your ERTC applications and all this stuff, and many of them are legit. Some of them are just looking to make a buck and get information from you and to do something that you could do on your own potentially if you take the time to inform yourself. Others are going to say, yeah, I don't have time. I may have the time, but I have no desire. That's fine as well.
Um,
So, Jack, sorry, Gary, is it okay if I hop in with a question, or do you have something you want to pop in on?
yeah, go for it, and then let's make sure we address Matthew's last
Yeah,
question here that came in
no
the chat.
worries. So you got this $5 million hurdle that if you're not at it, that's when you opted in reporting, right, Jack? If I'm above,
Yeah. Assuming
yeah,
the other two are that you're operating in the US. Yes,
yeah,
absolutely.
yeah, that's right. So I mean, you're basically, it's funny because like that's arguably the audience that will be the least likely to get the memo that this is required. So I mean, have you guys had some thoughts within Shoemaker about, okay, we're going to send out like client memos, but, do we just assume that's enough? Or do we want someone to actually, you know, positively affirm that they've got it covered so that we don't have to worry about it? Like so I'm trying to think like a lot of companies that are below $5 million. I mean, the reality is, you know, some of them may have formed themselves. So they don't actually have a relationship with an attorney. Others, it's like they may have had a relationship. They haven't talked to that person in hopefully in 4 or 5 years because there's been they haven't been sued.
Yeah.
There haven't been any major changes. Haven't done anything differently. So do you guys had any thoughts around how you keep track of like, I'm making this up, but like Shoemaker has, 2,000 people that would qualify, kind of tracking, all right, when do we stop worrying?
Yeah, we're doing all that we can in current communications. We thought about putting something in the auto signatures, but that's just noise. People don't pay attention to that.
Yeah.
I will tell you in our engagement letters, even if we are not being tasked with forming the entity, there's language in there that notifies them of the CTA and these requirements, and that we are not going to do anything about that unless we are specifically instructed to do that. Because, you can imagine it's like, hey, wait a minute, we hired you in March. We didn't know that we had to do this. And so, by 2025, because we were formed 5 years ago, and so you should have told us that. It's like, okay, well, we did in your engagement letter kind of thing. And so
Mm.
we're doing all that we can. I mean, some of it is CYA, but a lot of it is, most of it is, and the intention is to inform clients of this, I think, onerous requirement, but nevertheless, it's required unless things change later in the year.
So Matthew has this question. He says that at the start of the show, there was mention that entities created before 1/1/2024 don't have to report until 1/1/2025. Should we hold off until after the election to report?
I mean, that is the perspective that some are taking. I think that I don't think that this completely goes away. I think what will happen is that the entities that are formed between now and November, because there's going to be a mass flood of those, as business continues just in a normal course, that the government will say, well, we're just going to continue to do it. I mean, why not? Because people have become accustomed to it, and they're just, there's going to be a lot of complaining and grumbling, but it's for the greater good of the entire world, because this is a database that's going to be shared across the globe with law enforcement. So let's lead the way. Let's lead the charge in the U.S. of doing good things for good people and punishing the bad people. I don't know how this is going to go over in other countries. I mean, we've seen how other countries have been assertive with respect to things like the internet and privacy concerns and those kind of things. So, and I candidly have not been monitoring what's been going on in other jurisdictions, because dealing with this has been plenty enough a distraction on this topic.
Yeah. Well, Jack, you did a very good job, thorough as we would expect from Jackie.
Never gonna let that one go.
I know.
I never knew that. So I learned something new today. My day is complete. This is really awesome.
As soon as I said
Uh,
that, I in my head it was dope. So yeah.
Yeah. You want to put that baby back in the bag.
and for anybody that came on here new, we'll be back here, Lord willing, next week, same time, same channel, 11 o'clock. And we'll go into some more tax stuff. There's plenty of fun and frivolity happening up in the DC area, and there will be, especially with budget loomings and all the kind of posturing for last minute heroics and the falderall that DC is known for. So we'll do our best to help you kind of navigate that kind of stuff too. But January is a good time to get things straight and get things in order for going forward. So we can talk more about like how do you do that. So we'll commiserate between the three of us and we'll come out with a theme for next week.
I want to
So
throw out a little teaser too that's been
yeah,
on my mind. So, I read things like in the Business Journal and the Wall Street Journal, Charlotte Business Journal, Wall Street Journal, about predictions and comparisons of 23 to 24. And I think, maybe we spend some time next week talking about some of those things that, with respect to labor costs, supply chain, just various topics, and just touch on them and just share what other people who think they know things have been sharing. So I'll throw out that teaser that would be part of what I would want to talk about next week, regardless of the main topic.
I'm intrigued. That sounds great.
All right.
Okay. Well, we're at the noon hour. We're going to let everybody go. Thank you guys for being on here. We appreciate it. Thank you, Jack, for going deep into this topic because it's really important. So thank you. If you need a good attorney, talk to Jack.
Thank you.
All right. Thanks, guys. Have a good
Thank
one.
you.
All right, see you
See
Bye.
guys.
y'all. Bye bye.